topics and opinions expressed in the following show are solely those of the hosts and their guests and not those of W4CY Radio, its employees, or affiliates. We make no recommendations or endorsements for radio show programs, services, or products mentioned on air or on our web. No liability, explicit or implied, shall be extended to W4CY Radio or its employees or affiliates. Any questions or comments should be directed to those show hosts. Thank you for choosing W4CY Radio.
Barry G. Fowler, EA, brings you Tax Talk for You right here on W4CY Radio and Talk4 TV. As an enrolled agent and a national leader in tax resolution, as well as trucker, bookkeeping, and tax planning with over 30 years of experience, Barry will break down taxes, bookkeeping, tax planning, and tax relief for individuals and businesses just like you. So let's have some Tax Talk for You with your host, Barry G. Fowler.
Hey, good morning. It's a wonderful Monday morning. Always glad to be here talking taxes, of course, bookkeeping, and of course, a great reach out to all of our fabulous friends that are in the trucking business and our clients that are listening to this show as well. You know, today's one of those days where you come in to the office, have things you have planned that you need to get done and things you need to do first thing in the morning. And, you know, we get up early and get to the office early so we can get those things done. And guess what? Always running behind. And I mean, you know, that's just the way life goes. You know, if you're in the trucking industry, you know, you get dispatched to a job and then you sit and wait for them to load the truck, and you can't get to the places you need to be as soon as you need to be there because you're always dependent on somebody else. Well, in this case, this is purely dependent on me. And, you know, we go through and take the time to get prepped for the show. Man, I'd love to have questions today because questions would make my life a lot easier in doing this show. And so we always enjoy the questions. So if you got questions, message us. Let's get them in here. We're talking again about the one big, beautiful bill. You know, people ask me, you know, hey, can you summarize this really simple and real easy? Yeah, it's a lifesaver. It prevented going back to the tax code of 2000, you know, prior to 2017. It continues the Trump tax cuts, which was great for every American across the board, and especially, you know, the middle class and those with a little bit lower income, because it provided a lot of benefits. And, you know, people have said to me, hey, this bill only benefits the rich. Well, you're listening to talking points. You know, you're not looking at what was actually in this one big, beautiful bill. You know, Trump signed this into law July 4th, and it made permanent the Tax Cuts and Jobs Act of, I think it was 2017. And then it introduced a lot of new provisions. I mean, if you think about it, you know, it put in there the higher standard deduction. It increased child tax credits. Now, you know, if you think about the rich, you know, what was important to them is something the Democrats were fighting for, and that was because they're in states that have higher property and state income taxes. They were trying everything they could to increase the state and local tax deduction when you itemize. Now, most people are not itemizing these days. You know, yes, if you got a new mortgage, your mortgage interest is a lot higher. And then, you know, with mortgage interest being higher, then, you know, you might be able to get over that new standard, you know, deduction. And, you know, getting over that standard deduction sometimes gets harder because, you know, the standard deduction now, if you're married filing joint, is $31,500 with this new tax law. So think about that. In order to be able to itemize your state taxes, your local taxes, your mortgage interest, all has to be greater than $31,500. Add in their charitable contributions. So this law wasn't out there to help the rich, because they've got to be able to itemize. So they have some limitations on what you can take on state and local taxes. It was $10,000, and it's moved up to $40,000. So that means you've got to be paying a lot of mortgage interest, a lot of property tax and state and local taxes, just to be able to get to the point of itemizing. And not to say that average Americans can't itemize. It becomes a lot harder to itemize because you've got to get over that standard deduction amount to be there. So, that's really the crux of this. So you've got to really think about it. Hey, it's great. Riley, thanks for asking the questions. Why do they keep changing our taxes? And why do we even have to pay so much in taxes? Well, first off, they keep changing the tax code all the time. They think it's a lot of times to benefit people, and it's really to benefit the government. Realistically, if the tax code was as simple as it was back when they originally created it, I think it was back in 1917, paying only 1 to 3%, man, everybody would think that would be great today. Those would be ideal rates. And if they never changed it from that, it would be fantastic today. But the government has gotten into, I'm getting on my soapbox here, so, hey, I'm going to say it like it is. Government's got into catering to its constituents. So how do they keep getting elected? By keep giving money, doing projects, doing things that benefit you or I to get us to vote for a particular person or party. If the government would just step back and do what's in the Constitution, then maybe our taxes could be a lot lower. If you want to know what's in the Constitution, pick up a copy of the Constitution and read it. Back in the days, it used to be church and family that you relied on to help one another. Today, we place a lot more reliance to help on our government. Hey, who am I to say what's right and wrong? Everybody has their different beliefs, but I'm going to tell you this. If we relied on church and family and not the government, then government isn't that important. Government provides the structure. Family provides that helping hand. So, hey, that may be my soapbox for today. And maybe we'll get more in my where I can preach. We got another question here from Ralph. It seems like they tax our pay before we make it, after we make it, and again after that. It's taxes, taxes, taxes. Ralph, you're absolutely right. They've got Social Security tax, which never was meant to be this high of a rate. It was never meant to be your sole retirement. It was meant to be the safety net. But they turned it in to what everybody thinks should be their retirement instead of the safety net. And then they tax you your federal income tax. Now, hey, I don't know how old you are, Ralph, but if you remember way back into the 80s, tax rates were much higher. Tax rates have continued to go down. It started with the Reagan Revolution and Reaganomics in lowering the tax rates and bringing down the highest tax rates and bringing down the lower tax rates. But it came with a lot more spending and deficits. And the more spending we have and the more deficits we have, the more money the government needs from you and I. See, the government doesn't operate like a business. Oh, here we go. Soapbox again. The government operates like money is free. Money isn't free. It comes from you and I. And that doesn't just count the federal government. It counts state governments. It counts local governments. Counts even here in Texas, school districts, which is a little government in its own. And they tax you. So again, you had your Social Security, you had your Medicare, you have your federal income tax. If you live in a state with state incomes, you got state income tax. And then they hit you with sales tax on everything you buy. Of course, some goods are exempt, foods, necessities, but sales tax nevertheless. And if that isn't bad enough, they hit you with property taxes. And so you own your property, but you got to continue paying the government to have your property. Seems like a never-ending battle. And it doesn't end. If you put money into an IRA or 401k and it's not Roth, they tax you when you withdraw it. If you take the money out before you're 59 and a half, they tax you with a penalty for early withdrawal. So yes, it's taxes, taxes, taxes. I mean, if you ever wanted to hear it, there's only two things certain in life: death and taxes. And even when you die, you might be subject to inheritance tax if you own enough property or have enough assets. But it gets harder. Hey, we're going to keep talking about the one big, beautiful bill and answering your questions right after this.
We have only scratched the surface of today's show. Please stand by as Barry G. Fowler will be right back with Tax Talk for You. If you owe the IRS or are going through an IRS audit, don't go at it alone. Call Taxation Solutions Tax Relief at 888-930-1016. We are your solution for IRS debts, audits, back taxes, garnishments, liens, and levies. Whether you're an individual or business, you need a solution and a strong, aggressive tax resolution. Don't let the IRS walk all over you. Stop the IRS now. Call 888-930-1016 or go to taxationsolutions.net now for a free, no obligation consultation. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler.
Hey, welcome back. One big, beautiful bill. I really enjoyed the new tax code and keeping the original tax code that we've been operating under Trump's. At least this time they've put it in and made it permanent. They'll make changes and they'll tweak things, but there's a lot of beautiful things that are been in this bill. Now, if you're looking for some of the stuff like the senior deduction, overtime, no tax on tips, these things, we have the One Big Beautiful Bill podcast we did it's a couple of weeks ago. You can go to taxtalk4you.com, see our podcast there, go to iHeart, Spotify, wherever you may be listening to your podcast, and you can see and listen to our podcast on the One Big Beautiful Bill. What we're trying to do is cover the things that maybe we didn't give much coverage to last time, and continuing to answer the questions that you have about this One Big Beautiful Bill. So maybe we can simplify it. If you really enjoy some light reading, you can pick up a copy of the One Big Beautiful Bill and read almost 900 pages of it. Or you can listen to Tax Talk for You. We get to summarize things for you, clarify things for you, and make your life a little bit simpler. But if you like sleep, read the bill Hey, we read through the whole bill. We pulled out the things that are important tax-wise for you. We got through the riffraff. Maybe one of these days we'll talk about all the fluff that they put in this bill, because there isn't a single bill out here that doesn't have fluff, waste of money, or waste of time. They could have made it really much simpler, but they've got to do things that cater to you, I, and others across there. They did do an enhancement of the dependent care assistance contribution. So beginning in 2026, Section 129A2A increases the annual contribution limits for employer-provided dependent care assistant programs. Hey, we put the initials in there for short, DCAPS. It is commonly referred to as the Dependent Care Flexible Spending Arrangements. So those FSAs, the new limits starting in 2026 is $7,500 per year, $33,750 for married individuals filing separately, and that goes up from the current level of $5,000. So next year, you're going to see this new limit of $7,500. This dependent care assistant programs allows employees to set aside pre-tax income for qualifying dependent care expenses such as daycare, preschool, and certain adult care as well. And then the contributions are excluded from gross income, reducing your federal income tax, Social Security, and Medicare taxes. So that's a pretty nice part. Those increased limits are going to help families with higher annual child care costs, allowing greater tax preferred deferrals. And with the cost of daycare these days, you need every bit of help you can get. I looked at what my son and daughter-in-law were paying for their first child in daycare. Oh my gosh. And I know she was a teacher, and she after they've had their second kid, she and my son made a decision that she wasn't going to work anymore because they just couldn't afford to keep both kids in daycare and her working. She was just working to pay for daycare, which is just incredibly insane what they're going to have to go through and pay, and then what they'd be left over with. So it's great for them to be able to do that. Not everybody can do that, but the cost of daycare these days, sometimes you got to do what you got to do. If you're a taxpayer and you claim the child and dependent care credit, the same expenses can't be used for the credit and the dependent care assistance FSA. You can't use the expenses on both sides, so you've got to go through and do that. I got a question here from Nellie. Can you run through things that they put in here just to distract from the facts? You know how they put things in to pull our attention from what is really going on. And we're going to leave that for another long day, because there's a lot of things in this bill that I consider to be fluff, things that, hey, what they did. So let me just break this down real quick. What they did is they didn't just do a tax bill. So it wasn't just a bill that said, hey, we're going to do this bill and do taxes. They were doing one whole bill to fund the government, which, in funding the government, it becomes full of a little bit of fluff. And, senators, congressmen need things in there because they got to be able to come home and say, hey, I got this road project or that road project. You just saw that, or I just saw this morning online, a congressman or senator out of, I don't remember what Fetterman is, out of Pennsylvania was just talking about $1.2 billion set aside to, be for infrastructure in Pennsylvania. hey, there are things that need to be done. Yes, we need to improve our roadways and we need to do this. Sometimes we got to step back and take a look at what it's costing us to do these things. And is there a better or more effective way of doing it? Coming into work this morning, I saw that they were building a new 2-lane bridge, to help the flow of traffic. And it was going to cost a couple $100 million. And I look at that and go, wow, is the price of concrete that high these days? Is the price of building this structure that expensive these days? What are we doing? Maybe we need to step back and look at the costs and how we're doing things. And maybe there's a better way of doing things. But, hey, I'm not into construction. I don't know what the construction costs are. I just know that when, we were looking to do something and add on to our house, the costs were going to be exorbitant and we just couldn't afford to do it. Well, if your country and nation is in debt, maybe we got to look at better ways of doing things. And maybe 1.2 billion isn't the right answer. Maybe the right answer is finding a better and more effective way of getting construction done. And maybe there's a better route to go. Hey, again, hey, this isn't meant to be a soapbox day, but we're definitely going to look at this bill and come out here and tell you all the different things that are in this bill that kind of put the fluff in there and, not necessarily distraction, but more of how did we pay to get the votes to pass a bill that should have easily passed if you were just standing on keeping the tax code the same and enhancing the tax code and making it better for every American that's out there. They did do an enhancement to 529 plans starting after December 31st, 2025. It's going to increase the annual limits on distributions from 529 plans from 10 to 20,000. It also allows distributions to be used for additional educational expenses in connection with enrollment or attendance in elementary or secondary public schools. So private, religious. So, there's some nice things that are going to be going in there as well. This bill did some good enhancements, things that we saw that went away that affected, middle class and lower income people. And it had the impacts on them. So if you're not itemizing those impacts, it kind of hurts you when they took things away. So you saw a couple of years we had where you could take $600 as charitable contributions. Well, that went away. And, they didn't look at bringing any of that back until they started looking at what can they do to enhance this bill and help people make more charitable contributions. You see, if you can't deduct it, not everybody gives out of the kindness of their heart. Some people give out of the kindness of, I'm going to get a tax deduction for it. So having a little extra incentive for people to give when there's natural disasters or just to give, period, is a good thing. And we're going to talk about how they changed this bill to give you the incentive to make charitable contributions right after this.
We have only scratched the surface of today's show. Please stand by as Barry G. Fowler will be right back with Tax Talk for You. As an owner-operator, you already spend too much time away from your family. Trucker Tax Tools handles all your bookkeeping and taxes no matter what level trucker you are. Life on the road can be taxing, but that doesn't mean that your wallet or time with your family should suffer. Trucker Tax Tools makes your life run smoothly. Go to truckertaxtools.com for a free guide that will give you the tools to never worry about your taxes again. Call Trucker Tax Tools 877-966-2477 or go to truckertaxtools.com now and let the experts keep you trucking. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler.
Hey, welcome back. We're talking about some of the key provisions affecting individuals on this tax code. We talked about, how they changed 529 accounts, and now we're talking about charitable contributions. So for tax years after December 31, 2025, this is one they should have just made effective this year. It would have been really nice to do. But the One Big Beautiful Bill Act reinstates and enhances Code Section 170P, which provided charitable contribution deductions for non-itemizers. So if you're taking the standard deduction of the 31.5 as a married filing joint, you're going to get now a permanent deduction of up to $1,000 in cash contributions for single filers, $2,000 for married filing jointly. And then if you're itemizing, it's going to impose a new 0.5% AGI floor on charitable contributions. So if you're itemizing, you got to get over 0.5% of your adjusted gross income. That's kind of a bad thing to put out there to do, especially since you're going to give married filing joint a $2,000 deduction. Now, you can't just take the deduction on your taxes unless you actually are contributing money, church, charity, and it's got to be a valid charity. You're giving just to an individual to give to an individual is not a charitable deduction. They've got to have the 501c3 or 501 status out there to be able to have this deduction. Child tax credits have been increased to $2,200 per child beginning at 25, and it indexes for inflation. There are things in this bill that adds complications. Now they're going to come out with a deduction for car loan interest. Does my car count? I got this last year. No, it's a new deduction of up to $10,000 of qualified passenger vehicle loan interest. And it's interest on debt incurred after December 31, 2024, and it's only allowed for tax years 2025 through 2028, and then it has a phase out when your modified adjusted gross income exceeds $100,000 or $200,000 a married filing joint. So no, if you bought your car last year in 2024, this doesn't count in 2025 or anywhere out there. They have some other restrictions about it being made here in the United States. There are specifics behind this rule that they want out there. Interesting. It's kind of help offset the cost of these exorbitant interest rates that we see. Now, we talk about interest rates and how high interest rates are. Back in the 80s, these interest rates would seem reasonable. When we were dealing with, high and exorbitant interest rates back then, it was 70s and 80s, and you didn't have those 2%, 3% mortgages that, we had the luxury of having. Inflation being under control right now, we're not seeing inflation going there. You would assume the interest rates are coming down, but they have yet to come down. And interest rates being high affects not just you and I, but also affects our federal government because of how much debt our federal government is in. Hey, maybe next week we'll have a complete lecture about our federal debt and how much interest we're paying based on the amount of debt that we have and how the federal government allows that much debt for our federal government when you and I could never be that overloaded with the same amount of debt that the government is. Hey, maybe that's a fun thing for another topic. Let me know. Post comments. Do you want to hear about our national debt and the things that we got going on here in this country? Health savings account enhancements for plans beginning after December 31, 24. That one big, beautiful bill permanently extends the safe harbor, providing that health plan will not fail to be treated as a high deductible plan because of not having a high deductible for telehealth services. So, there were some limitations on these bills and being able to use a HSA, health savings account, because the deductible on telehealth wasn't considered to be high deductible. Beginning in 2026, this bill also is going to have individuals with high deductible health plans also enroll in direct primary care arrangements, and it allows HSA funds to be used to pay for dependent care services up to $150 a month for individuals, $300 a month for family arrangements. And then for all bronze and catastrophic health insurance plans on the exchange to be eligible plans for the purpose of making HSA contributions. Woo! Yeah, try saying some of that stuff real quick, 10 times over. It's some of the things are kind of crazy out there. Some of the things they threw into this bill. Hey, gamblers, let's talk about gambling. You got gambling winnings. I want to deduct my gambling losses. Beginning in 2026, one big, beautiful bill further limits the term losses for wagering transactions in code section 165. 90% of the amount of such losses. Any deduction for gambling losses remains limited to the amount of gambling winnings, and still got to itemize. This bill, it is one big, beautiful bill. A lot of pages, a lot of things, a lot of changes that are out there. It's going to have some inflation adjustments as we go. The QBBBA, I always laugh when I see this in the abbreviations for, notes or things that we're taking. And, it's a pretty long abbreviation. One big, beautiful bill act makes also those TCJ, Trump tax cuts, individual rates permanent, and provides for extra year of inflation adjustments for the 10, 12, and 22% brackets. Hey, that's nice. It's giving you those adjustments, and those are the lowest brackets that are out there. It also enhanced the standard deduction, and it makes it permanent and further enhances by increasing the amount for 2025, just like we talked about. You're going from 15,000 or going to 15,750 for single filers, 23,625 for heads household, and 31,500 for married filing jointly. So it was an across the board increase of 5%. And that's going to be the new base for inflation indexing after 2025. So there's a lot of things that we can go through and do, and it's going to make your life a little bit better, a little bit easier to use this bill out there. We've been talking about individuals, and we've been talking about the things that, helped you. We're going to go back and talk about no tax on overtime. We're going to talk about the senior deduction and no tax on tips a little bit more when we come right back after this.
We have only scratched the surface of today's show. Please stand by as Barry G. Fowler will be right back with Tax Talk for You. As an owner-operator, you already spend too much time away from your family. Stop spending time doing paperwork. Go to truckertaxtools.com, a solution built specifically for truckers. Truckertaxtools.com makes your life run smoothly. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler.
Hey, welcome back. I got a question here from Chet. I'm an owner-operator and over the road. What does this bill do for me? Hey, I'll tell you what. Get on your CB radio and hey, tell your friends, tune in right now to Tax Talk for You. I'm going to give you about 2 or 3 minutes to message all your friends out there because we're going to talk about some of the bill that we have out here for trucking that's in this one big, beautiful bill. As a matter of fact, it helps all business across the board. I'm going to address really quick, no tax on tips, no tax on overtime, and Social Security. And then we're going to talk about trucking. So you got time to get your friends to listen to us. Go to Tax Talk for You or W4CY Radio. Hey, deduction for tip income. This bill created an above-the-line deduction of up to $25,000 for qualified tips received by an individual in occupation, which is customarily and regularly received tips. It does have some phase outs out here. And this no tax on tips is not permanent. It goes from 25 through 2028. If it works really well, I can see them making this permanent or extending this. And then you're subject to some modified adjusted gross income levels, anything above 150,000 or 300,000 in joint. No tax on overtime. Again, this is only from 25 to 28, and it creates an above-the-line deduction for up to 12,500 or 25,000 in the case of a joint filing. Qualified overtime compensation is defined as what's paid to an individual under Section 7 of the Fair Labor Standards Act, FLSA. And then you got your phase outs as well over there. And another temporary deduction is a deduction for individuals that have attained the age of 65 before the end of the tax year. The deduction amount is $6,000 per individual. The senior deduction begins phase out once it's over 75,000 or 150,000 married filing joint. And again, it's phased out after 2025 to 2028. So if you're a senior, that's technically no tax on Social Security, no tax, and then no tax on overtime, and no tax on tips. Remember, it does phase out after 2028. Maybe they'll come back and make it permanent. Truckers, business owners, the bill was chock full of things to help you in business. Now, I hope you got on your CB radio. I hope you maybe got on the phones and text message your friends. And I hope a lot of you went over to Tax Talk for You and hit that as one of your favorites, or go over to the Facebook page, Trucker Tax Tools Facebook page, Taxation Solutions Tax Relief Facebook page, or, again, Tax Talk for You and Tax Talk for You. And that's the number 4 and the letter U.com, Tax Talk, the number 4, and then U, just the letter U.com. And you can hear this, and then you can go and get our podcast and tell people, hey, we talked about what kind of savings we've got for business owners and truckers. They expanded the qualified business income deduction and made it permanent. The current 20% rate and increases the deduction limit phase-in range from 50 to 75 for non-joint returns and 100 to 150. In addition, The act introduces a new inflation-adjusted minimum deduction for taxpayers who have at least 1,000 of qualified business income from one or more active trades or businesses in which the taxpayer materially participates. Hey, if you're an over-the-road trucker, you're participating in your business. If you've got QBI, you then have a minimum of $400 you're going to be able to take for being in business. Now, you also, in this bill, permanently extended the additional first-year depreciation deduction, and the allowance has now been increased to 100% for property acquired or placed in service on or after January 19th, 2025. Now, if you bought your truck January 10th, put it in service in before January 19th, guess what? You don't get the 100% deduction. You've fallen under the old bonus depreciation rules. But if you didn't put it in service until after then you can possibly take the bonus depreciation. Now, I also warn you, don't count on 100% depreciation, because sometimes that isn't the best benefit for you. Hey, a lot of times I hear from people that told me, hey, I talking to somebody else and they took 100% depreciation, they paid zero tax. Well, if you paid zero tax, then you possibly wasted depreciation that was on income that was taxed at 10% or lower. And maybe your business is going to be such that you could use more deductions in the future to save yourself more money in the future than what you're going to save today. Got to do some analysis out there. Don't fall for the trap of your tax person trying to make themselves look good by giving you a large refund at a cost of future refunds or future lower tax rates with the use of depreciation. Same with Section 179 expensing. The one big beautiful bill increased the maximum amount a taxpayer may expense under Code Section 179 to $2.5 million. Hey, I'm glad to see they increase this deduction, but I'm going to tell you what. If you're buying a $2.5 million truck or tractor and trailer, you're never going to make it in the trucking business. Now, if you decided you're going into the trucking business and you have getting a fleet of trucks, then yes, we can possibly use Section 179 to depreciate the maximum of $2.5 million. Now, it's reduced by the amount by which the cost of qualifying property exceeds $4 million. So if you're buying $4 million worth of trucks or more, then you're going to be reducing that $2.5 million down. The 2.5 and the 4 million are going to be adjusted for inflation for tax years beginning after 2025. This rule applies to anything purchased and put in service after December 31, 2024, so anytime this year. So those are a couple of really nice things that are out there. You, as a trucker, are also going to be able to deduct per diems. Now, per diems and everything, what you've got to look at is nights away from home on the road. Per diems right now are at $80, maybe inflation adjusted come later this year. Last year, we got a huge inflation adjustment that took place October 1st. So you had to make sure you were tracking the difference between your days in the beginning of the year through October 1st, and then October 1st to the end of the year. And then you got the inflation adjusted amount for the last 3 months in the lower amount, $69 in the first part of the year. And then 80% was deductible. So it was a real nice adjustment. We'll see if they're going to do the adjustment again this year. It took them a few years to do it before, but again, you've got to have a tax home. You got to have something that you're caring for and taking care of, paying for. Um, Maybe it's fully paid off and you're paying just to maintain it, whatever the case may be. You've got a home, and then therefore, when you're out on the road, those nights away from home, you'll be able to take the deduction. Now, remember, the first day you leave, you get a half a day, and the day you come home, you get a half a day, but everything in between is a full day. So if you're reporting to us that I was on the road 425 days last year, first thing we're going to tell you is there are only 365 days in a year. Second thing we're going to tell you, that means you never returned home, and therefore you don't get the per diems, and therefore you take actual expenses. That's it. So realistically, every trucker I know returns home to spend some time with family. If you're traveling in your truck and you have no home, you're considered a tax turtle, and therefore the per diems are not out there. Vince asked a question about the per diems. Does that include if you are renting, or do you have to own? You can be renting an apartment. That works. You can be renting a home. That works. You can own a home, own a condo. Those things work. And matter of fact, if you got a home or apartment or whatever, there's some advantages that you can actually lease the place, your home or your apartment, to your business for up to 14 days. And it's got a lot of qualifications you can do on it, but it can be tax-free income or expense for your business out there. Alex, with his question is, with the tax changing all the time, can you really plan for future taxes? Yes, no, maybe. So what you're planning, and when we are planning, is we are looking at what the permanent tax code is. And then we plan around that tax code to begin with. We also look, when we're planning, around what are the temporary things in the tax code, and how to use these items to best impact you personally on your individual taxes. Or if you're running a business, like we do with Trucker Tax Tools and working with truckers out there, we help them plan to save the most money for their business. And then via that, we're saving as much money for them personally. The one thing I could say about tax planning is adaptive, meaning we're adapting year in and year out. Every year we're looking at, net income. What things can our owners of our businesses do that would help their bottom line? Now, bottom line is both before and after tax bottom line. So, maybe it's putting more money away for retirement. Maybe it's, if you've got employees, offering a 401k program that helps save taxes for both the employer and the employee based on what's being put away. If you are a sole owner, maybe it's putting a solo 401k in place or a simplified employee pension plan. If you've got a high deductible HS health plan, maybe it's putting money into an HSA and maximizing the tax deductions there. Maybe it's finding a way to put dependent care plans in place that help you or your employees across the board. These are the things that you do in tax planning and how to save money for you and I as a business owner, and then as an individual. So tax planning, you have a lot of variables. Now, if you're an owner operator, I'm going to tell you the best thing to do right now is pick up the phone and call Trucker Tax Tools. And then go to truckertaxtools.com, put in your information. We'll call you. We'll get you set up. We'll talk about your bookkeeping, your taxes, what we do to save you money and make your life run more smoothly. But again, it starts with going to truckertaxtools.com. Hey, I'm running out of time and I've been long-winded. Make sure each week what you do is you come here to taxtalk4u.com. Follow us there, follow us on Facebook, and never miss an episode, whether it's our podcast, iHeart, wherever you listen to podcasts, look us up at Tax Talk 4U. But be here every Monday, 10 a.m. Eastern Time, right here on W4CY Radio. Thank you. Have a God bless, glorious, and awesome week. We'll see you next week.
Are you an individual or business that wants to understand taxes and how they affect you? Are you looking for specific tax advice for self-employed, business owners, and truckers? Are you behind on taxes and your bookkeeping? Are you dealing with the IRS and ready to have some relief? Then you need Tax Talk for You, hosted by tax and trucker expert Barry G. Fowler, EA. Tune in 10 a.m. Eastern Time every Monday right here on W4CY Radio and Talk4 TV. Don't forget to check this and past episodes at taxtalk4u.com. See you next week at W4CY.com.